Hello everyone, my name is Farhan. Today you'll solve question number 5 from 2019 past exam. In this question, you'll do the allowance for doubtful debts for 2 different months. Now in this question, we're not just going to solve it only, but also understand the core concepts behind why things happen, so that way you can make sure that you have a thorough understanding on how things work and get full marks in the main exam. So make sure to focus and follow through the entire content. So with that being said, let's begin. So Outside Climber sells hiking equipment to clubs and the general public. So it reports on a monthly basis. For the month ended 30 June 2019, credit sales were $95,000 and sales returns were $5,000. We are given the balance for accounts receivable at 30 June 2019, which is $122,000. Now, the second paragraph of the question says that on 30 June 2019, we are concerned about a declining accounts receivable turnover and about possible bad debts, and we decided to raise an allowance for doubtful debts equal to 2% of net credit sales. The first requirement of the question is to do the journal entries on 30 June 2019 to record this allowance. Now let's look into the workings on the right-hand side of your screen. So starting with the first information that we've got from the first paragraph. So we understand that the net sales for June 2019 is calculated by finding the difference between the credit sales and the sales returns, which is mainly to subtract the $5,000 of sales returns from the credit sales of $95,000, and you get $90,000 as the net sales for June 2019. Now, based on the requirement of the question, we are setting a 2% allowance on this net sales. So if you want to calculate the allowance for doubtful debts, we calculate it by multiplying 2% of the net sales amount of $90,000, and you get $1,800 as the allowance for doubtful debts. Now, my question to you, based on the given scenario, what do we understand by declining accounts receivable turnover? Now, a declining accounts receivable turnover simply means that the business or the company is taking long to collect the payments from their accounts receivable, or which means the customers are not necessarily paying on time and they're paying later than what is expected from them. So what we're going to do to record the journal entry on 30 June 2019, which is the requirement of the first question, is to record the allowance. Now, when you want to record an allowance, what's happening is that we're increasing the balance for allowance for doubtful debts. Because recording the allowance simply means that you have to increase the possibility of bad debts that we expect to not collect in the future. Now, allowance for doubtful debts is what we refer to as a contra asset account. Now, what is a contra asset account? Now, a contra asset account tracks reduction for a relevant asset account, and the relevant asset account in this case is the accounts receivable, which refers to the credit sales, including GST, that we have made to our customers. Now, because we understand that the main purpose of recording an allowance for doubtful debts is to record the possible amount of bad debts, what we have to do in this case is journalize this. So we journalize this is to debit the bad debts expense by $1,800, and we credit the allowance for doubtful debts by $1,800. So what this means is that we are increasing the allowance by $1,800 based on the calculations we have run, which was to multiply 2% of the net sales amount of $90,000, and that's how we get $1,800. But at the same time, because we are increasing this possibility of bad debts, we also have to debit the bad debts account itself by $1,800, which refers to the expenses of the business going up. So when we debit bad debts by $1,800, we're increasing the expenses of the business, which is what we're going to report in the income statement. And when we credit the allowance for doubtful debts by $1,800, we're increasing the contra asset account, which records the possible amount of debts that may go bad. And this is called a contra asset account because this tracks the reduction in a relevant asset account, which is the account for accounts receivable. And these accounts receivable are those customers of the business to whom we sell items or goods on credit. Okay. Now, I have a question for you. If you were to prepare the ledger account for allowance for doubtful debts, how is all this going to work out? So let's look into that. So here I have an outline for the allowance for doubtful debts account. Now, allowance for doubtful debts account, as we have already discussed, is a contra asset account. And what is a contra asset account? A contra asset account tracks the reduction for a relevant asset account. Now, the relevant asset account in itself in this case is the accounts receivable, which by default should have an opening balance on the debit side. So if contra asset tracks the opposite of what happens within this accounts receivable, which is to record the reduction for this accounts receivables, then the contra asset account logically will make sense to have an opening balance on the credit side. So that is why we start with the opening balance on the credit side when we prepare the contra asset account. In this case, for the month of June, beginning 1st of June, we do not really have any opening balances that are given in the question. So I'm just writing here OB for short. And this is 0 in this case, which in the future, if you're preparing another allowance for doubtful debts account, you should start with a different opening balance based on the amounts that were given in the question. Now, based on the calculations we have done for the journal entry, we know that at the end of the month, the allowance for doubtful debts is $1,800. Now, if the opening balance is 0, which we record on the credit side to begin with, then the ending balance should be recorded on the debit side based on the fundamental rules of accounting, which I'm sure you're familiar with. So on 30th of June, we record the closing balance. I'm just going to write CB for short. You can write just the balance word here, and that is $1,800 based on the calculations that we have done. Now, if I was to close this allowance for doubtful debts account appropriately, how can I do it? So you see that at this moment, for the month ending 30 June 2019, you can see that there is a deficit of $1,800 on the credit side, right? So how do we balance that deficit? So let's calculate the total of everything on the debit side, which is $1,800, which must be the total of everything on the credit side as well to make sure that the accounting fundamental rules apply. So the missing balance here in this case for the month ending 30 June is what we refer to as the bad debts expense. Okay, so this bad debts expense is going to be $1,800, which is the amount that we report in the income statement. And this bad debts expense that we are debiting within the allowance for doubtful debts account as a cross-reference is what we can see within the journal entry that we have prepared, where we are debiting the bad debts expense account by $1,800 and we are crediting the allowance for doubtful debts account by $1,800. So this essentially means that if you were to record this journal entry within this ledger account, then on the credit side of the allowance for doubtful debts account, you will record the bad debts expense of $1,800. Okay, so with that being said, I think we should move to question B now. So part B says that on 18 July, which is the next month, accounts receivable totaling $2,750 were written off as unrecoverable. So this is bad debts written off. Net credit sales for July were $110,000 and the balance of accounts receivable as of 31 July was $135,000. Okay. On 31 July, the accountant decided to increase the allowance for doubtful debts to 3% of net credit sales. And then the first requirement of Part B is to do the journal entries on 18 July 2019 to record the write-off, and then on 31 July 2019 to record the new allowance. So let's start with the write-off that we have for 18 July 2019. So if you have to write off, that essentially means that you are confident that the accounts receivable, they have confirmed that they're unable to pay, which means you have to reduce the accounts receivable, which means you have to reduce the asset. And if you're reducing the asset, you have to credit it. So to begin with, we are crediting accounts receivable by the entire amount of $2,750. This is because this $2,750 is not just the original sales amount, but also it includes the GST. Because in Australia, how do things work? When we make sales on credit, we also calculate the extra 10% that gets added on top of the original sales amount. So this $2,750 that these guys used to owe us, this actually refers to the GST including amount as a whole. Okay? So you credit the accounts receivable by $2,750, which essentially means that you're reducing the assets, and because you're reducing the assets, you have to credit it in this case. Now, this $2,750 can be broken down into two components. $2,500 being the original sales amount and $250 being the GST amount. Now, how did I find the GST excluding amount of $2,500? So I simply took the $2,750 that we have in terms of the amount that these accounts receivable used to owe us, and then divide with 1.1, which factors in the 10% GST rate, and we get the GST excluding value to be $2,500. And the $250 is just simply the difference between $2,750 and $2,500. So if you have to record this write-off, you have to debit the GST clearing by $250. Why we are debiting the GST clearing by $250? When we debit the GST clearing account, we're essentially reducing our obligation that we have with the ATO, right? So because we are now for sure confirmed with the fact that these accounts receivable are unable to pay us back the money that they owe, we know that this GST also needs to be reduced in the GST clearing account, which by default is a liability account. So when liabilities go down, we have to debit it. So that is why we are debiting GST clearing by $250. And the other figure is $2,500 that also needs to be included on the debit side. And that is called the allowance for doubtful debts. Now, when we debit the allowance for doubtful debts by $2,500, what we're essentially saying is that we are confident that $2,500 from the previously recorded possible bad debts amount that we have stored in the allowance for doubtful debts can now be removed. Now, allowance for doubtful debts by default is a credit account, which means when it increases, we understand that the allowance for doubtful debts goes up, or we expect more bad debts in the future. Now that $2,500 have been confirmed by the accounts receivable, we can offset this $2,500 against the previously stored amounts that we had within the allowance for doubtful debts ledger account. So that is why, to offset this against the previously stored credit amounts, we have to debit the allowance for doubtful debts account by $2,500. Okay, so the final entry is to debit the allowance for doubtful debts by $2,500. We debit the GST clearing by $250, and we credit the accounts receivable by $2,750. Now, what's happening on the 31st of July, 2019? Now, we know that now we have a new rate for allowance, and that is 3% applied on the net credit sales. So in this case, the second last paragraph of the question actually gives us the net credit sales of $110,000, which means if you want to calculate the allowance for doubtful debts, you simply multiply the given percentage of 3 on the net credit sales of $110,000, which gives us an allowance for doubtful debts of $3,300. Now, we want to show what happens in the ledger account, and this is very important that you understand this. So here I have the allowance for doubtful debts account again, and you can see that I have the opening balances and the closing balances in this case. Now, the opening balance in this case is on the credit side, and we just had a discussion a while ago. Why is this on the credit side? Because this is a contra asset account, which tracks the reduction of a relevant asset account, and that relevant asset account in this case is the accounts receivable. So to begin with, on the credit side, we have an opening balance on the 1st of July, and that is $1,800. Where did this come from? Based on our calculations from Part A. If you recall, for the month ending 30 June 2019, we've calculated the allowance for doubtful debts by taking the 2% and multiplying it on the net credit sales of $90,000, which gave us $1,800. So that $1,800 that we had at end of 30 June 2019 is now the opening balance on 1st of July, which is what you can see here. Then on the debit side, I've included the closing balance based on the calculations we have just run a while ago, and that was $3,300 based on the 3% new rate that we multiplied with the net credit sales of $110,000 for July 2019. Now, what's happening next? In this month, on the 18th of July, we also confirmed that $2,500 from our accounts receivable, which is the GST excluding amount, is not going to be collected anymore. So which means the allowance for doubtful debts account now needs to reflect this. And how does it reflect this? We record this within the debit side of the allowance for doubtful debts account, which simply refers to the bad debts that we have written off. Now, what's the logic here? Now, allowance for doubtful debts account by default is a credit account, which means when we increase the allowance for doubtful debts, we have to credit it, and when we decrease the allowance for doubtful debts, we have to debit it. So allowance for doubtful debts is a record of the possible amount of bad debts that we may have. So this is like a provision. This is not something that has happened for sure, but you want to keep some amount aside from this so that you can take decisions based on the fact that possibly you may not collect the sales in the future, and you want to be certain in terms of how you succeed in case things don't go well in your case. So Now that this amount has been confirmed that we're not likely to receive, this is what we're recording on the debit side. So to reduce the credit that we originally had, we record this on the debit side. So we show cross-reference of accounts receivable, and that is $2,500 in this case. Now, how do we balance this account? So the yellow highlighted thing is what we calculated based on our balancing. So how did we balance it? We found the total of everything on the heaviest side, which was the debit side, which gave us 5,800 in total. That must be the total of everything on the credit side. And once we subtract the opening balance of 1,800, you get $4,000 as the missing figure. And that $4,000 is what we call the bad debts expense, which is something similar that you have seen in Part A as well. So this bad debts expense is reported within the income statement. Now, how should we generalize this? Again, this can be generalized based on the fact that the allowance for doubtful debts account is being credited by the bad debts as the cross-reference. So that is why, which is what you can see here. So credit allowance for doubtful debts by 4,000 and debit bad debts by 4,000. So this basically means that you are increasing your allowance by $4,000 based on all the calculations that you've run for the month of July 2019. Right? So before we go to part C, is there any questions that you have? If you got any questions, make sure to post them down in the comments below. So let's start with part C, which wants you to report the accounts receivable in the balance sheet at 31 July 2019. I'm pretty sure all of you know what to do. We understand this accounts receivable is a current asset account. So here we are given the balance sheet extract outline, and I've just filled in the numbers. And this is to be done for the month of July 2019. So accounts receivable at 31 July 2019 is $135,000 based on the information we're given in the question. And then we're subtracting the allowance for doubtful debts of $3,300, which was the amount we calculated at 31 July 2019, based on the 3% applied on the net credit sales of $110,000. So the net amount that we get at the end is $131,700. All right, so before you go, I have a question that I need you to answer as well, which is a discussion question, and this is going to help you in exam in case you get something similar, and this is also going to train you on how to answer similar questions in the exam that's on November 13. My question to you is, explain how can a business take care of its reducing accounts receivable turnover? So I think I've written the question wrong here. So the question should actually be, let me fix it please. So explain how can a business reduce its declining accounts receivable turnover, which is the case that we are working with at the moment. And let's just assume this is a 2-mark question. So what I need you to do now is take 10 seconds, pause the video, and come up with ways on how you can get the score 2 out of 2. Right. Okay, so let's maybe get started. So here I've got a couple of points here. So starting with the first one, which is to have a strict credit policy or a strict assessment of a customer's credit. Now, only credit-worthy customers can get to receive extended credit terms. Now, you want to make sure that the customer is not broke and the customer has actually got money and the business of the customers is doing well. So when you want to extend credit and you want to build relationships with these customers, you want to first verify that they're doing well, and that way you can for sure know that they can pay back within the time limit that you're giving them. Then on a monthly basis, you want to review the credit limits of these customers. You have to make sure that if these customers are paying on time, that means you will get to do business with them in the future where you will give them the credit terms again. And this helps you get rid of the inventory, which may become obsolete if you just keep them in your warehouse, but rather you would want to get rid of them as quickly as possible, given that you know that your customer's financial condition is good and they're not broke and they can pay you off eventually and meet their obligations within the extended credit term that you give it to them. Next, the next thing you can do is to offer early payment incentives, which is referring to the discount. Now, from our perspective, if we are the businessman ourselves in this case, and we want to make sure that we get the money in advance, not in advance, we get the money as quickly as possible from our credit customers, we would want to offer them incentives, which is what we call the discount expense. That is normally what we record under other expenses in the income statement. Now, the benefit to this is we get to have a cash flow, like we get to collect the cash quickly, which means we have cash available for investment in our operations, such as acquiring more inventory and also taking care of all the expenses that we incur in the course of our business operations. But then again, there could be a disadvantage to it as well. Now, if you are to give out discounts and you are doing that a lot, then what's going to happen is that your expenses are going to go up, and this becomes a problem for the business because your reported profit will also go down. Now, this is just a disadvantage in the case of offering early payment incentives. And I think you should also know that while there's a benefit to giving discount, which increases the cash flow of the business and helps the business sustain or survive in the short run, it may not necessarily be a good thing in the long run because your net profit, it takes a hit because of the expenses that go up and the less amount that you are able to collect. So these are different ways of looking into the problems that we've got. And when you assess the problems in your future workplace as well, you need to make sure that you understand the problems very well and see the pros and cons of solving those problems and how that may impact your business decision moving forward. So that's all for today's lesson. But before you go, I need you to check the link in the description. It is a group call, a 90-minute group session on reconstruction of ledger accounts, where you will learn to reconstruct 8 ledger accounts. And we will do the accounts receivable, we'll do the accounts payable, inventory, we'll do the GST clearing, we'll look into prepaid advertising, prepaid rent, accrued wages, etc. So this is a 27-mark comprehensive question, which is something similar that we expect in the upcoming exam. And this question also requires you to use the results that you get from the reconstruction of all these ledger accounts, use the results, and then prepare the financial statements, which are the income statement, the balance sheet, and also the cash flow statement. We'll also understand the meaning of operating, financing, and investing activities when we prepare the cash flow statement. Furthermore, we will also discuss the ethical and financial considerations that are associated with the relevant case study for which we will do this reconstruction and financial statements for. So this block is only limited to 15 people. It's happening 10 days from now. It's a 90-minute group call. If needed, I'm happy to stay more and answer all your questions and make sure that you get the best results possible. So guaranteed, this is the best session that you're going to get on budgeting. So make sure you check the link in the description and book your call because this slot is going to run out very soon. And I'll see you in the next video.